Welcome to the Well-Rounded Retirement Podcast with John and Jim from CRIS Financial. In this podcast, we help you take a well-rounded approach to retirement planning so you can retire with complete certainty. If you're looking for proven and straightforward retirement advice, ranging from how to protect your assets to how to spend with confidence, this show is for you.
Hello and welcome to Well-Rounded Retirement with Jim Donewald and John Glowacz from CRIS Financial. Gentlemen, how are you?
We're doing good today, Eric.
Good, Eric, man. How are you?
I am fantastic. It's a beautiful day, and I'm just loving the fact that I get to talk to you guys today. And
right.
You told me that we're talking about annuities, and I would say that word by itself conjures up a whole lot of thoughts, because for years we've heard annuities are bad, or annuities are great, or annuities are just the right fit. But I think there's a lot of misconception out there. So obviously this is a good topic for you guys to be talking about because you're the experts. So where do we begin with the topic of annuities today?
Well, I think that we really need to start, Eric, with what is an annuity? An annuity is a contract between you and an insurance company in which you make a lump sum payment or a series of payments. In return, receive regular disbursements beginning either immediately or at some point in the future. That's basically the definition of an annuity.
All right. You said something there that I didn't realize. You said that you could actually start taking payments immediately, but if you're purchasing an annuity, why would you want to take payments immediately when you already had the cash on hand and you could just pay yourself?
Well, basically what you're doing, when you mentioned at the beginning of this broadcast, people have good news, bad news, all sorts of annuities. I'd say all of that is correct. Well, we find that most people, when they're unhappy with the product they have, it's not necessarily the product, it's the way they're using it. Somebody either sold it to them to accomplish something that it really is not designed to do, or just they're misinterpreted. So with the annuity, you can do it, like you said, they all come in all flavors. So really what we want to do is see what the client is looking for. But you can start payments from them immediately. The reason you would do something like that is because once you start an annuity, it is guaranteed for life. It will last as long as you do. So whether the market improves, declines, whatever happens there, you can still get a consistent payment. So typically we'll fund these over years and don't start them right away. But with an immediate annuity, and they used to be more popular when interest rates were higher, because you could put that into an immediate annuity and they will pay you more. They'll pay you some interest on that. But right now at all-time lows, immediate annuities are not my first option.
Got it. Okay, that makes sense.
So, some of the benefits of the annuities, people would say, so who would benefit from this? And I'd say basically anybody. It just kind of depends on the purpose. Well, John and I are talking to clients. We don't have any preconceived notions as to what we're going to show them or offer them. We're trying to solve whatever problems they have. And I think people forget all the time, Social Security is an annuity. Who benefits from Social Security? Everybody.
Yeah.
But you don't necessarily, everybody isn't dependent on that as their sole source of income. So like I say, our clients come in all shapes and sizes. And annuity may be a part of the plan. John and I just really feel it's more of a plan than a product. What we do is advise our clients on a prescribed path that we know will work. The plans, or the products, I should say, change all the time, but the plan does not. And that's what we're really looking for. So if somebody needs guarantees, somebody has adverse risk to the market, somebody's looking for guarantees and accumulation, that's when an annuity is great. We try to embrace the vehicle of whatever they're trying to accomplish and not worry so much what it's called.
And we try to keep the definition of it simple as to what really the purpose of the annuity is, because they come in all different shapes and sizes, and there's no one size fits all. There's 4 main varieties: fixed, variable, and indexed, and each with its own level of risk and or payout potential. So there's a lot of reasons why people would place their savings into one of these accounts, because they're looking for safety. They're looking for some sort of income distribution at some point in time, either now or in the future, and they're looking maybe to leave a legacy to their heirs.
All right, John, you said there were 4. I heard 3. What's the 4th one?
The 4th one is the immediate annuity that Jim just spoke about. But the immediate is more, if you're looking for some key words that would describe it, it's more like a pension. And you would basically take your assets and you deposit them into this account, and then the account would begin to pay immediately an income from this account for as long as you lived, or to your spouse as long as she lives.
Got it. All right. So let me ask you this. It sounds like pretty much anybody could benefit from an annuity if it fits their personal plan. But when should somebody be purchasing an annuity? I mean, is it smart for somebody who's 35 to do it, 45, 55, or, getting close to retirement?
I wish younger people would do it, but it's really not suited for them. It's probably better, or at least people don't really get serious about it until they're 50 or so. One of the reasons being there are some restrictions to it. So if you were to do it much earlier in life, this money is it would be like you put it in an IRA. You can't take it out pre-59 and a half without a penalty. So that's why, and then let's be quite frank, when you're younger, you got kids, you got a wife, you're trying to buy a car, you're trying to, they just don't have probably the assets to do it, and it's not their top priority. They have other priorities at that point. So really, when you get into your 50s, getting close, that's what we see is really when people are willing to take the action. And by then, maybe they've got an old 401k that they've got from another company, something that they can move into that. So you have to have the assets to do it. And then, quite frankly, we find that really age probably 50 and up. I mean, the sooner the better, because it's compounding. We like that. But the reality of it is that I would say probably 50 and up is when this really starts to come into play. It can really do the most benefit for the clients.
Because at that age, they're basically transitioning from pre-retiree into retiree, and they're looking for that safety or that lifetime income guarantee that only an insurance company can actually say contractual guarantee, and then the legacy aspect of the annuity, where it's multi-generational and goes from you all the way through your grandchildren, however you want to set this account up. So there's a lot of different directions that we go into with the annuities based on what your goal is, or what your needs are at the time that you decide to put this asset or these assets into this annuity.
Yeah, and that makes a lot of sense. And now that you've kind of clarified that it's 50 and above, that 50 to 60 range is when most people have adult children that hopefully have moved out of the house by then. And they're probably paying a little bit more in taxes now that it's just a husband and a wife and no kids to claim and all that jazz. So are there any good tax benefits from an annuity?
It's tough, because here's what happens. So if you have after-tax money and you put it into an annuity, the gains on it are tax deferred. So that's the good side. If you have an IRA and you put it in something like this, there are no tax benefits. So a lot of people say, would you still put an IRA in this? And I'd say, once again, it comes down to the purpose, but I would say, yes, we do it all the time. The reason being safety. The tax advantage is already there. So we're not putting it into annuity for additional tax advantages. We're putting it in there because it's safe, and this is money that we need to protect, and we're going to count on for income. So if it's a after-tax account and you put it in an annuity, the interest on that will be tax deferred.
All right. So this is the time to clear the air about good things and bad things about annuities, right? So give me some pros and cons.
Well, I think one of the things that people hear a lot about are, the variable annuity, and that's the one that's probably created the most issues of the 4 different types of annuities that there are, because it provides you an opportunity for potentially higher return, but it's also accompanied with greater risk, and they have nosebleed level fees. And so going into a contract like a variable annuity, which is basically the assets are in 3 different sub-account mutual funds, and based on the performance of those mutual funds determines how they credit interest. So not only do you participate 100% in the upside, but you also participate 100% in the downside. So you could actually lose money in these contracts, and then by the time you've paid the higher fees on these accounts, it's almost like they don't make any money. So they really don't understand the contract themselves because they're very complicated. And we try to keep our thoughts on annuities very simple, because there's 2 different phases. There's an accumulation phase, and then there's a payout phase. So just like Social Security, you paid into it your entire working career, and then you get to a point, 65, 66, now we're going to start taking the income distributions. And annuities the same exact way. You pay into it, You let it defer, you grow, and then at some point in time in the future, you're going to start to take those income distributions from that account.
So it sounds like the variable annuity loses that safety aspect.
Well, absolutely. I mean, we call them annuities, and this is what's kind of confusing. A variable annuity is actually still a security. So you need to be securities licensed to sell that. A fixed index annuity or a fixed annuity is an insurance product. You need an insurance license to sell that. So they're two different. So we prefer the insurance annuities over the variable annuity. We do assets under management. We have other ways to accumulate funds. But when we're looking for safety, like we mentioned earlier, we want the best vehicle that's going to work for that. And for me, for safety accumulation, you can't beat the insurance annuity type, rather than the securities.
And on the fixed and the fixed indexed annuity, there's some built-in safety mechanisms that are in place, such as dollar-for-dollar reserves, reinsurance carriers, capital surplus of the company. Jim, can you expand on the legal reserve system?
Well, it's designed to help these insurance companies. So rather than the FDIC, which is, we're all familiar with that, and that's why we'll put $250 in our checking account, which is great. The Federal Reserve or the legal reserve system is just basically the counterpart to that. And so people say, well, which is better, which is safer? And I don't say really one's safer than the other. I think they're both outstanding. But as John just mentioned here, these insurance companies, the claims paying ability is backed by these insurance companies, which in turn, how they protect themselves is, like you said, dollar-for-dollar reserves, huge cash surpluses. We always believe bigger is better. We like the big insurance companies of around a couple 100 years. So it's a system in place that's very effective. Insurance companies get sold from time to time. We're talking life insurance companies now, not property casualty, anything like that. But they don't go out of business. If they have a cash flow issue, they're typically purchased by another insurance company.
And we always ask our potential clients, who's got the biggest building in town when you drive into a town? And it's generally an insurance company.
They squeak when they walk, and we like that.
Yeah, Mutual of Omaha building's pretty big here. It's pretty tall.
They're big. Well, you know what? They know what they're doing, and that's it. They're just money managers. That's what they've always been. And since they have accumulation of, law of large numbers, they can predict pretty good what's going to happen.
They're professional traders. That's what they do for a living. Dynamic hedging.
And they're good at it. So, for the portion of the funds, we trust them implicitly with that.
Yeah, I think a lot of people's concern over annuities is what happens if I die? All this money that I paid in, where does it go?
That's another one that a long time ago, things were different. This is not your father's annuity, so to speak, but the money passes to the family. The insurance company doesn't keep anything. There's a big misconception. I know with some company pension plans, if you work for a company for 20 years and you take the pension plan and it's a single payout, let's say, and you walk out in the parking lot and you get hit by a car, the company then retains the money that's left over. With the insurance company, it doesn't work that way. So somebody is going to get those funds, whether it's your spouse or your heirs, your kids, leave it to the church. We don't care. But the money gets passed on. The insurance company does not keep it.
It's multi-generational, basically, is what Jim is saying. And a lot of those products that you're talking about, Eric, they're obsolete these days.
That's good to hear. All right, so let me break this down again because I'm having a little trouble understanding it. If I buy an annuity and let's say I purchase it at 65 and I'm having it start paying out at 70 and I put in, I don't know, $500,000. That sounds like a good round figure. $500,000. If I take it from 70 to 90, is there anything left? How do I know that? How do I know what my family's going to get? Have I received all my benefit at that point? How does that math work?
Good question. Math works like this. The longer you live, the better the deal it is for you. It's just that simple. Because here's what happens. So we hope that these funds inside these insurance contracts, there's a way to credit them, and that's a conversation for another day, that grow. But there are certain guarantees with these insurance companies. And even if the assets, your physical deposit of $500,000 runs out, the insurance company will guarantee that this keeps paying you even if there's no money physically left in your account. That's one of the huge benefits. That's the payment for life option or lifetime income. So how much money is going to be left? We don't really know. I mean, we can estimate that depending upon there's a few things that go into that. So it's one of those deals. The longer you live, the better the deal it is for you. Whatever funds are left will pass on to your heirs.
And that's one of the risks that we want to alleviate you from is longevity risk, because we don't know how long we're going to live. We don't know how long our money is going to last. And with a contractual guarantee annuity, it's going to be a lifetime, whether you live to 90 or to 100.
All right. So do you get any growth from that annuity? So if I deposit $500,000, I wait 5 years to even begin my payments, that money should have grown somehow, or is that all the insurance companies? And I'm only getting paid out of that $500,000 for the rest of my life. So if that, like you said, if the $500,000 is gone, then my family's going to get nothing if I pass after that. Maybe I pass earlier and there's $100,000 left of my $500,000. Does that go to them? How does that work?
There's absolutely growth on the product. Like I said, these come in all flavors and sizes. So I'm going to speak in generalizations here,
Okay.
But we're going to get some guarantees from the insurance company, maybe that this thing is going to grow at 5% or 7%, something along those lines, and then we're going to take income from it. So we will get growth on it. Then we will start, as John said, we'll start the payout phase, at which point, that it's going to eat into the principal. The guide here for these funds really is to provide income. These are not what we would consider, these are not the growth funds that I want to, pass on to my heirs.
Mm-hmm.
These are the funds I need to live on. That's why we believe, we wouldn't put anything, 100% of any client's assets in any one thing. You need a plan, as I constantly say, not a product. This is one of our tools. It accomplishes a great thing to provide X amount of income for you, but it is not the answer to everything.
Got it. All right. I think a lot of people would also be concerned about the liquidity. You guys have spoken about that on many podcasts, being safe and having some liquid assets and also investable assets. How liquid is an annuity?
Annuities are pretty liquid. I mean, you got to remember what are we trying to accomplish? If we're trying to accomplish long-term income, they're not 100% liquid. Having said that, you can take your money out at any time. If you take a CD out, if you got a 1-year CD and you take it out of 6 months, you're going to have a small surrender charge on that. Annuities are in that same family. That's why, again, when we put a plan together, we want to make sure the client has plenty of liquidity. But having said that, there's plans out there you can take 20% out of them in any given year. That's a pretty sizable chunk of money just to stop any holes in the plan here or something like that. I don't know why you would need to be taking a lot of money out of it.
Well, these are long-term investment vehicles as well too. So the insurance company, in order to have the payout that they normally have, they're going to have to need your money for a long period of time. And if the plan is to take out your money sooner than what the product offers, or before your income strategy start, there's no point in getting into an annuity. So we have to look at basically what your need is, what your goal is, and how you can. But you can get out of there. You can get out of the contracts. You have a vanishing surrender period, and you can get out of it. But you have the liquidity from the free withdrawal mechanisms that are built into the contracts.
Plus, what we figure, if we do our plan correctly, the client has other liquid assets. And if something major happens, what happens typically, a health issue, many of these companies waive any kind of surrender fee if there's a health issue. Obviously, if the client passes away, there's no surrender issue to the heirs. So, the big stuff that would probably get in your way that you wouldn't be able to plan for, the insurance companies plan and say, look, we're not going to kick you when you're down. If you're sick and you need this funds for that, a lot of them are very liberal on how you can get to your funds.
Fantastic. This has been a lot of great information already. We're a bit into the podcast, getting close to the end, and I want to make sure that I give you guys time to really just convey what else do we need to know about annuities.
Well, like I said, they're all flavors and sizes. So we have to figure out what we're trying to accomplish. Once we can do that, we can start, whittling it down. I'll tell you right now, we're not a fan of the variable annuities. We like other products in the market for that kind of stuff. We like the fixed indexed annuities. But you need to do a little research on that. And this is where we come into play, because we work with these every day, day in and day out. So we look for excellent crediting strategies. We look for caps, margins, spreads, all this little nuanced stuff that you need to be up on just to make sure that we're getting the client what they are looking for.
There's over 2,000 insurance companies out there with different products and plans, and we have the strategies in order to find those particular companies and narrow it down to what fits your need and your goal.
Yeah, there's a few choices.
Yeah, it sounds like it. So if somebody wants to have this discussion, or maybe I didn't ask all the questions that other people have out there in the audience, I'm sure there's a lot of really, really people that are much smarter than I am listening to this, and they have some questions for you. How do they get a hold of you so they can have this conversation?
Well, they can, call our office at 281-391-7608. That's 281-391-7608. Or they can go to our website at www.wellroundedretirement.com. There's a contact page that's on there that they can click on and send us the information. Or they can just email us directly at either John or Jim at CRISFinancial.com.
Gentlemen, always a pleasure. Learned a lot today, and I like the fact that you tell the good and the bad. It's not just, hey, you got to get this, or you can't ever touch those, because I think that's where a lot of the media goes to. They don't have that, hey, let's talk about the real deal, the positives and the negatives, and the fact that each individual person has to have an individual conversation with a professional to know if it's a good fit or not. So I appreciate your time. I appreciate your honesty today.
Thanks, Eric.
Thank you, Eric.
You bet. And I thank you for listening and tuning in to the Well-Rounded Retirement Podcast with Jim Donewald and John Glowacz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jim and John come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at CRIS Financial, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Well-Rounded Retirement Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of CRIS Financial. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.